So, Nano Dimension just dropped its Q4 2025 earnings, and folks, this comes after one of the absolute wildest years a company could possibly have. The big question on everyone's mind is this. After all that chaos, are we looking at the start of a massive turnaround? Well, let's dig in and find out. But first, let's start with a little thought experiment. Just imagine a company goes all in, right? They buy out one, but two of their main competitors in the same month. Super bold move. But then, just 3 months later, one of those shiny new acquisitions completely collapses into bankruptcy. What do you even do then? Well, this isn't some business school hypothetical. This is the exact story of Nano Dimension's 2025. Now, to really get what's at stake here, you have to understand who Nano Dimension is. We're talking about a company that operates in the super high-tech world of digital manufacturing. They're making mission-critical parts for industries where failure is just not an option. You know, defense, aerospace, next-gen computing. The kind of stuff where the precision has to be absolutely perfect and the pressure is always on. Okay, so to make any sense of these new earnings numbers, we first have to rewind and look at the absolute turbulence of 2025. What's just incredible when you look at this timeline is the sheer speed of it all. In April of 2025, Nano Dimension bought two huge rivals, one right after the other, Desktop Metal and then Markforged. On paper, it looked like a brilliant move to consolidate the market, but by the end of July, the whole thing had turned into a nightmare. Desktop Metal filed for bankruptcy, which forced Nano Dimension to basically write off the entire deal and pivot, and do it fast. So after that acquisition roller coaster, you can bet all eyes were on their Q4 financials. Did the company actually manage to survive the fallout? Let's take a look at the report card. And here it is, the official press release. And honestly, the headline was a surprise to a lot of people. The company announced a really strong finish to the year. In fact, they exceeded their own financial guidance for both revenue and profit. This was the first real sign that maybe, just maybe, they were turning the ship around. So, the big headline number, full-year revenue clocked in at $102.4 million. A huge chunk of that, of course, came from the one acquisition that actually survived, Markforged. And to put that number in perspective, that's a massive 77.3% jump from the year before. Now, yeah, a lot of that is because of the Markforged acquisition, but it just goes to show you that the scale of this company has fundamentally changed. But you know what? This is the number that management was probably even more proud of. I mean, it's one thing to grow your revenue, but it's another to do that while also shrinking your losses. Their adjusted EBITDA loss, which is just a fancy way of looking at profitability, it narrowed by over $10 million. And that is the key takeaway here. They're growing sales while cutting costs. That's the playbook for getting to profitability. So how on earth did they pull this off? Well, it wasn't just luck. It was a brand new, super disciplined strategy that they put in place right after that Desktop Metal collapse. The company's CEO, David Stellan, he laid it out perfectly. The new playbook was really simple and direct. Drive operational discipline, slash costs, and reduce the amount of cash you're burning through. In other words, after all the chaos of the acquisitions, the focus shifted inward, towards pure efficiency and execution. A huge part of this new discipline was all about focus. Instead of trying to be everything to everyone, they zeroed in on these 5 high-value industries. And why these 5? Well, because these are the sectors where their tech gives them a unique edge, and maybe more importantly, where clients are willing to pay a premium for that kind of cutting-edge performance. And here's the proof in the pudding that this new discipline is actually working. As you can see on the chart, they set a baseline for their operating expenses back in Q2, and by Q4, they had chopped them down by over 16%. So this wasn't just talk about efficiency, these are real significant savings hitting the bottom line. Okay, now, it's not all sunshine and roses. In the spirit of transparency, the company also reported something called a material weakness. What that means, basically, is that the sheer complexity of those 2025 acquisitions put a huge strain on their accounting team. It's really important to note they said they don't expect to have to restate any past results, and they have a plan to fix it, but it's definitely a key risk factor to be aware of. All right, so with 2025 in the rearview mirror, what's the game plan for 2026? Let's take a look at the company's official forecast. And here's the outlook. They're expecting revenue to keep on climbing, hitting somewhere between $130 and $140 million. But again, more importantly, they expect to keep shrinking that adjusted EBITDA loss, projecting it to fall to between $40 and $50 million. If they can hit these targets, it would be another huge step on that path to profitability. Now, beyond just the financial forecast, there are three other big initiatives to watch. First, there's a strategic review that promises a clear path forward coming soon. Second, they're officially becoming a U.S. company, which should improve transparency. And third, they're hitting pause on their stock buyback program while they figure out the absolute best use for their cash. Which, of course, leaves us with the million-dollar question, or maybe in this case, the billion-dollar question. After a year of aggressive acquisitions, a shocking bankruptcy, and a really disciplined turnaround, Nano Dimension has put all the pieces in place for real recovery. But they've promised this clear path forward is coming very, very soon. So what will that path be? That's the big question for 2026.